So in this video, I'm going to talk about growing a business. So by the way, welcome to this channel. And I made a video earlier about, how fundraising, coming up with a business, with a strategy on how to fundraise your startup. And they gave a lemonade example in the previous video. So this video is going to be a continuation about growing your business. And I'm going to explain further what William Ackman is going to explain. But just give some more details to that. So let's watch it.
Should we continue to invest in the business? We've lost money in the first year. Time to give Actually, business generates.
So operating assets is actually the assets that you use, to kind of, definition-wise, to operate to run the company, right? So most of the time, if you have cash at hand, that's favorable. Dividends pretty much means if the company is public and you have to give some money back to shareholders, sometimes in quarters, sometimes monthly, sometimes annually. Depending on the company, they have different time periods in which they do dividends. So basically, this is the income statement. Income statement and provides the cost of goods sold, which is pretty much what the cost of lemonade stand is, the number of cups you need to have to for you making a lemonade, and the price per cup, right, gives a very good indication of the revenue that we get depending on how much is being sold, right? So think of the income statement as just revenue versus cost, right? And if you have net positive, it means the revenue is actually it means that you're having an increase in revenue, right? But if you have a higher cost of the goods sold, then you probably have a less profit, which is something that's going to explain moving forward. So just kind of clarifying that, so you can see the lemonade stands increases every year, so 1, 2, 3, 4, and 7. And so this is very speculative, right? Because this has not happened yet, right? In quotations, but ideally, if everything works out as expected, this is the kind of increase in number of lemonade stands you're going to have. Then cups sold per stand, increases steadily as well. And then, cups sold, you have that, which is just a multiplication of, the first line times the second line. Then a price per cup, which is the price that you sell each cup of lemonade stand, is, it has to increase steadily because in addition to inflation, but also you want to also show that, to maximize growth, right? You also have to be steadily increasing the price of the per cup, right? So you go from 1 to 1.05 to 1.1 to 1.15 to 1.2. And so the cost of goods sold is, is the investment that you put into, purchase the operating assets, right? And that gives you 200, 420, 622, 926, 1702. And so basically, The depreciation is just a standardized value, right? And if you think of, this is very relative, right? So it depends on how and what's the benchmark that you use, but there's a steady increase with that as well. You can make some assumptions if you want. Labor cost is the number of people you hire per limited standard, right? And that's steadily increasing. So from there, if you just subtract that revenue from all the less just means you're subtracting it. You get now your EBIT. EBIT is equivalent to your profit. And so EBIT is their profit, basically. And that's your margin. Your margin now is that 10 out of your revenue. So it's 10 on 180 times 100, right? Gives you the 1.3, right? And you do that all the way to the year 5. Mm-hmm. Oh, my apologies. So yeah, net income, rather EBIT, without taxes and interest, is that's the profit. So my apologies. EBIT is actually a term that came off from finance. It's highly used, and it's used a lot, especially when you're calculating enterprise value. And I think that's a very interesting concept. But once you subtract the interest and taxes, you actually get net income. So
If you think about this,
so this is the last one I'm talking about, the cash flow. So the EBIT could have been helpful here because you see you add back depreciation. And if you go back to this, let's get this right. So you see they take away, so literally, there's this minus depreciation because here, this net income has taken out the depreciation, right? Because it's such a depreciation. But depreciation is it's a non-cash loss, right? Because you don't literally get cash out. But since since the depreciation is not an actual cost, once it comes to these cash flow statements, which we're going to talk about it, they add back the depreciation, right? So sometimes people just use EBIT, right? Because at the end of the day, just subtracting the um, just the interest is good enough, right? Because the only difference between net income and EBIT is just the interest, and I mean the the taxes taken out. But most of the time, just having the EBIT and subtracting the interest can take you back to this. That makes sense, right? I mean, but basically, you can just say net income is much easier if you want, and you just add depreciation back, and you get now the cash flow from the operations only.
the balance sheet.
Yeah. So basically, I think this goodwill was based on that. You know, at the end of the day, was the net that you got. If you guys can remember, let's take it back, guys, back to the. So it was this right here.
Sell 500 shares.
Yep. So that 1,000 is from that, and since you have $1, you as in $1 per share, you got that. Um, so let's get back to that. So we'll get overwhelmed by it. Forget to rush here. So I'm just going to end here. I think the goal. Yeah. So basically, I think the goal here is CapEx is literally the the like it's comparable to, you know, the loss of the fixed asset, right? And I think they got it from I think it's sometimes it's given. I think it's given somewhere, right? It's given somewhere. Yeah, right here, right? So this capex is the cost of the fixed assets, right? And they subtract it out of this. Sorry, I'm going back and forth. Just want to explain what's going on here, right? So this is that fixed asset cost. So it gives you the cash flow for the investment, and then when you add now everything, you're gonna give the ending cash, right? You know, this is the debt, you know, and the equity, which is the cash that they infuse in the business. And you see, if you add this plus this plus this, you're gonna get 500, right? Plus 750, right? Minus 300 is 450. 450 plus 50 is 500, right? You know, if you use an Excel spreadsheet, it's pretty easy. But I'm just gonna end it for today. There's not much. The example here just gives you how, when you start a business, you look at the income statement, you look at the balance sheet, but most importantly, the cash flow statement, right? This is the most important thing that investors look at in terms of projections, right? Because this is actual cash, and they call it free cash flow because they've taken out the you know, you have taken into consideration depreciation, capex, the debt and equity, right? So is this literally what you're gonna get in the back, right? So I hope this was helpful. I'm gonna make more videos like this, and if there is any specific video you'd like to watch about finance, entrepreneurship, I do post videos on episodes of people that I talk on my podcast towards within emerging markets. I also post videos on about a school I'm studying called Pre-Entrepreneurship School, where we help people fulfill the life mission of helping others and becoming the best version of themselves through workshops that we organize, like, you know, everything finance, some Mandarin classes if you want to attend, and many other interesting stuff, time management as well. So you can check that out on the link. I have my info as well on the YouTube channel as well. So thank you so much for stopping by. I hope this was helpful. I hope this might help you in your class. And I'm looking forward to seeing you in the next video. Please feel free to subscribe, like, comment, and give me feedback if this was helpful to you or not. But I'm always happy to hear from you. I'm hopeful that this is significantly beneficial to you. So see you in the next video. Bye.